And so if we're in an environment where we start to see this ratio continue to resolve lower, watch out. Watch out. What I want to talk about today is like, what is technical analysis? How can advisors use this? How can individuals, investors use this? Because a lot of people, they may not have been exposed to it. And so I just want to go through some things where we start at some basic levels, and then we're going to get into maybe some more advanced things that a technician would do. And then ultimately, I'm going to show you ways that we are actionably using this today here at Reveille to try to help our clients. So uh, I'll start out by saying that, technical analysis, it is not used for everything. You're not going to use this if you're looking to buy a business, right? A small business where you're going to be committing capital, operating that business. You're not using technical analysis for that. You may be looking at fundamentals of an area that you're buying into, or whatever it is, how much you're charging for this, what your material costs are for different things. That's when you're using fundamental analysis, right? You're not using it when you're deciding to buy a home, right, or buy a car. But when you are managing uh, when you're managing investments in the financial markets, in the public markets, where you've got ample price data to examine, this is the time to use technical analysis. So I just want to start with some very basic things here. Okay. So I want to start by looking at uh, just the S&P 500. And I'm going to throw on a very basic trend. Okay. I want us to start with just a moving average. That's all I want to start with. And let's start with, okay, the first one that comes up is a 50-day simple moving average. Okay. We're looking at a daily chart here. And so all this line does is show us the average price, the average closing price, mind you, of what has happened over the last 50 days. That's all this is. And that's 10 weeks, right? We've got 5 trading days per week, right? So 50 days would give us 10 weeks worth of data, but here we're looking at a 50-day moving average. If I decided that I wanted to augment this and I wanted it to be a 200-day moving average instead of a 50-day moving average, we're going to be able to see how that changes, right? We're going to be able to see that all of a sudden it's not following it quite as closely, right? So the first thing we want to focus on in technical analysis is simply identifying a trend in price. What's the direction of the market? And so, as long as prices are above a 200-day moving average, right, in this particular case, we could reasonably suggest that this asset class that we're looking at, this is the S&P 500, is in an uptrend, right? You're very rarely, I don't, if ever, going to see a period of time where the S&P 500 is below its 200-day moving average and be in an uptrend, right? That doesn't make sense. If prices are below trends, they are typically falling. If prices are above these trends, they're likely moving higher. Okay. So, first thing we want to identify is what's the trajectory of price. We use trends to be able to help us visualize that. Okay. All technical analysis is really visualizing this data. Now, there's one other version of this trend that I think that we could show, right? And that is, what if I don't want a simple moving average? A simple moving average is simply going to tell me I want to take each of these prior periods, right? In this case, of a 200-day moving average, I'm going to take the last 200 days worth of data and I'm going to provide them with equal weighting in my calculation, right? Another way, I could choose an exponential moving average, which is to say, I'm going to provide less weight to the data that is older, and I'm going to provide more weight to the data that is newer. So, an exponential moving average has a decay function built into it, getting really kind of heady on that. But all that means is what is happening now, what's happening most recently, has more weighting in the direction of that moving average. So again, all we're trying to discern here is what is the trend, what is the trajectory of an asset class. And then as an investor, I can potentially choose to make changes to the way that I'm positioned based on the way that those trends are working. Okay. Now, let's move on to the second piece of what we might want to look at here in technical analysis kindergarten. And I'm going to zoom out here. We're going to go look at a weekly chart, and we're going to zoom way out on the S&P 500. We're going to zoom way out, way out. Let's keep going back. The next principle we're going to talk about is called polarity. Polarity. And the idea behind polarity is that former resistance will remain resistance until we have eclipsed those levels, at which point in time it will turn into support. Okay. Same thing on the lows, that if you had a security, and we could go and find a number of them, that previously had support and it breaks down below that, that prior support will become resistance. Okay. So polarity, super important. This is why we like to look for previous levels where indexes or securities, where they stopped going up, where they stopped going down, because the likelihood could be that they're going to do it again, right? So if we're, this is zooming out a long way here, but in 2000, as the S&P was peaking, this is where buyers stopped buying in the S&P 500 at this 1560-ish level S&P. Do we think it's a coincidence that the S&P basically got to the exact same level in October, November of 2007 and stopped going up? Maybe it is, but it did, right? Whether it's coincidental or not, I know the market was different. You had different components within the market driving it. Regardless, the market stopped going up at those levels. Okay. And we did not breach those former highs until early 2013. When we got into early 2013, oh, hold on, here we go. Early 2013, we finally broke out from those former highs. And those former highs turned into support. Right? Those former highs turned into support. That's what we like to see in a polarity principle. Okay. I'm going to go to number 3 here. And this is, we've looked at polarity, we've looked at some moving averages. I want to look at what we call MACD. MACD, moving average, convergence, and divergence. So this is where a technician, again, we're looking to establish what the primary trend of a market is. But if we're looking to identify a change in that trend, then looking at the convergence and divergence of a short-term moving average versus a long-term moving average may give us a good glimpse into the pivots of when markets are moving from uptrends to downtrends, or downtrends to uptrends. Okay. And the way that you're going to do that is by evaluating, again, a short-term moving average of either daily, weekly, monthly prices, Compare that to what's going on with intermediate to longer term daily, weekly, or monthly prices. MACD, moving average, convergence, divergence. Okay. I'm going to move on. And I want us to look at this bottom pane here, which is known as the Relative Strength Index, or RSI. Now, this is where we start talking about things that are overbought or oversold. And a lot of people may have heard this concept of overbought or oversold, and uh, maybe they are not super familiar with it. But a lot of times, the nature of something being overbought, okay, which is what we're going to define overbought, is on this oscillator. Okay, this is something that moves from 0 to 100. That anytime you register something over 70, it's the way that I set mine up, you're in an environment where you say that this particular security is overbought. Okay. If it's less than 30, then you say that it's oversold. Now, what I want to say here is that the mere presence of overbought or oversold conditions do not suggest that a reversal to whatever this trend that you're in is done. Okay. First of all, overbought conditions are characteristics of bull markets. Oversold conditions are characteristics of bear markets. But oftentimes we see that the presence of overbought conditions, they result in more overbought conditions. The presence of oversold conditions result in more oversold conditions. So when we're looking at something like RSI, I don't want to focus simply on the presence of this thing is overbought on a daily basis or a weekly basis. Okay. I don't necessarily want to focus on that and then say, oh, because it's oversold, I think I need to get out and I need to and I need to be protecting myself against some sort of imminent decline. Okay. This on the other side of the foot or the other side of the coin here is just because something's oversold doesn't mean that I need to go in and start buying because it's going to pop imminently. It doesn't necessarily work that way. But here's the way that I like to conceptualize it, because there is a formula for RSI that is wicked, and we don't want to dive into it at all. But here's the way that I like to think about it. Because again, this is an oscillator, it goes from 0 to 100. And so, what I want to consider here is this is a voting mechanism. There are 100 investors that have a vested interest in whatever we're examining here. We're looking at the S&P 500 as an example. There are 100 investors, and we're effectively polling them to say, how many of you think that the direction of this asset is higher? And everybody who raises their hand, that's a tick mark. We're adding them up right here. If they think the direction of this thing is higher, if all 100 of them thought it was going higher, then RSI would register 100. If none of them thought it was going higher, then it would register as 0. Okay. Now, what I want to focus on when it comes to looking at something like RSI, again, is not necessarily how things look at a single moment in time. But what I want to look for is there a change in what that bullish or bearish reading might be? I want to find a period of time where we may need to get a little more granular here. I'm going to dive in and look at something like ExxonMobil. Okay. And let's look at Exxon on a weekly basis. How about that? And we're going to zoom out a little bit here. Okay. So we're going to go back to maybe the lows that we saw in the energy patch back in 2020. And so again, here we saw a massive oversold reading in Exxon in the spring of 2020. And you saw this with a bunch of stocks, but certainly a bunch of energy stocks. And the mere presence of that oversold condition it shouldn't have compelled you to say you need to go in and you need to buy this thing without equivocation. Now, we did see a temporary pop that was pretty good, but it rolled back down and you essentially came back down to the same levels. Okay. However, at the same price, Exxon ends up at the same price in October, November of the same year. And notice how the next time that we are polling these 100 investors with a vested interest in this security, and we say, how many of you think that the future direction of this stock is higher? Again, this is not exactly what's happening, but in effect, I believe this is what is happening. How many of you think that the future direction of this stock is higher? Well, back here in March of 2020, only 10 of them raised their hand. Everybody was on the other side of the boat saying, no, this thing is going down. And prices were washed out, right? We're at $30 a share. Fast forward 7 months, 8 months into the fall of that year, we're at the same price level. But now we take that same poll. How many of you think the future trajectory of this stock is higher? 30 of them raised their hand. 31 of them raised their hand. So at the same price, there's a change in sentiment that we are registering there. That is what we would refer to as a bullish divergence in momentum. The price of the security hasn't changed, but people's perception of the stock has changed. And those are the types of things that we want to be looking for, whether it's a bullish divergence or if it's a bearish divergence, if where somebody might have been very positive on that stock. Okay. You go back to 2011 when Exxon was at 90. Okay. Relative strength was at 82. How many of you are positive on the direction of Exxon in February of 2011? 81 people are raising their hand. I think it's going up. Well, not only does stock not go up, but we get 5 years later, we get into 2016. The stock's still at $90. How many of you think the direction of the stock is up? Only 60 hands, right? RSI is only at 60. Price is the same, but fewer people are suggesting that they think the direction of the stock is going up. And what happened, man, precipitated one of the worst declines ever, maybe in the history of Exxon. Okay. All right. Let's move on. And I want to talk about the last piece here and this is a more advanced thing. So we started at kind of a beginner type perspective. What's a moving average, right? What's the difference between a simple moving average, exponential moving average? What's MACD? How do we use that moving average, convergence, divergence to help us identify when trends are actually changing and rolling over? How do we incorporate something like the relative strength index or RSI into our calculus, right? That it's not just a single point in time that matters, but it is the change over time. And we want to evaluate how RSI changes over time when price is the same. And that is information that becomes a little more actionable for us. Here's the last piece, right? And these technicians who love to talk about their Fibonacci retracements and extensions. All this is a way to try to identify when we might see some additional supply or demand for a security start to show up. We talked about things like polarity, right? Well, we see here we're looking at a daily chart of Exxon that, kind of just south of $100 was kind of where that stock stopped going down back in late 23, early 24. Is it a surprise that in the tariff tantrum sell-off that we saw in April of last year that the stock found support at effectively the same level? No, right? That's polarity. That's prior support turning into support. Just as these former highs, they acted as resistance. until you can take them out. And then when you start to eclipse those former highs, now we're into uncharted territory for a name like Exxon, right? This is not a recommendation to buy Exxon, although we do like the value cohort right now. Send us an email, info@Reveille Wealth, and we'll fill you in on that. But now we're trying to determine, where do we think, now that we've got this open field in front of us, how far can this thing go? Right? We don't want to have just this unbridled optimism, but we want to start to understand, okay, how far up do we think that this thing can go? And so that's where we start to run these Fibonacci extensions, right? Where we're looking from prior highs down to lows. And it's just some math, okay? It's just some math. You can dive into it. Look at the Fibonacci sequence, and we see that anytime we're starting to break out of something like this, we're looking for a 1.618 extension, 161.8 extension of whatever this move is, high to low. And that should give us maybe a reasonable expectation of where we would start to see some supply come back into the market. Maybe we're going to start to see some sellers show up at that level, right? And I'm not going to go into all the periods of time historically with whether it's at the security level or the asset class level where these things have been super beneficial. But I promise you, it isn't voodoo. Somehow or another, it works. Okay. We see these principles, these Fibonacci sequences and stuff, they happen in nature all the time. Right. So looking at price, looking at polarity, MACD, RSI, fibs, right? These are kind of the basics of technical analysis. We still want to try to keep our charts pretty clean. All right. Now, where do we go from there? All right. This is where, let's take this, what we've learned about technical analysis, and let's apply it to things like intermarket studies. So intermarket studies, when we're comparing the relationship between one area of the market to another, this impact is very impactful for financial advisors. We're looking to allocate capital for people. And so we want to have an understanding of where someone's capital might be best taken care of. And so where there's been concern for a long time in the fundamental crowd about things like valuations in U.S. equities and in the S&P 500, it hasn't necessarily translated into underperformance vis-a-vis the international markets. Now, we've talked about how we believe that is starting to roll over. But we can, from a very big picture standpoint, we can apply this same moving average and say, well, the longer term trend here is still up, and it's still favorable for allocations to the S&P relative to developed international assets. Now, this is looking at that simple moving average. I just want to show you and notice the difference when we change it to exponential, right? How the slope of the line changes just a little bit, right? And that is because we're providing more weighting to what is happening sooner rather than equally weighting all of these prior periods, okay? Now, when we zoom in and we look at the daily, okay, we see that this doesn't look so persistent and strong anymore. The 200-week moving average still very much moving higher, okay? But the daily, man, this thing does not look, it's not corroborating what we see in the weekly, right? Same thing here. We can come down and look at what's happening with the relative strength index, and we see that we don't see those RSI readings as high as what they formerly were when price was at the same level. Okay. So we're starting to get a bearish divergence in momentum here, right? Price is the same. It's the same today that it was back in 2024 in this ratio. But people were wildly optimistic if they said, hey, who wants to take the S&P 500 instead of international stocks? And you had something on the order of 80 people raising their hand. That's me. How many of them want to do it now? 30? Right? So that is a massive change. That's a massive change in sentiment, and it will drive where people are allocating their capital. And it has certainly translated to a difference in performance in the market. International markets that we've been talking about have been outperforming, and we think that that is a theme that is just getting started. Again, we see the difference here between those simple and exponential moving averages. We see that we're on the simple, it's on that daily, it's trying to hook a little bit higher, but price is coming a little south of it. The exponential, we've already broken it, starting to move lower. Okay. Here's another one of these intermarket type studies where we're comparing one sector of the market, this is consumer discretionary stocks, to the staples. We talked about this polarity principle earlier, how these former levels of resistance, they should turn into support. But if it cannot, then that would be a failed breakout. We would look for that to come back lower. Again, check out the bearish divergence in momentum there, right? The last time price was at this level, which would have been early 2025, how many people would have been positive on the discretionary stocks versus the staples? How many of them are still raising their hand? Far fewer, right? So I just kind of find it ironic, and we talked about it at this PA in Miami, that this ratio is referred to as the best fundamental analyst on Wall Street. If the consumer discretionary stocks are outperforming the staple counterparts, then that's probably in a fairly robust economic environment. Maybe the stock market is doing well. When the shoe's on the other foot, right? The last time that we saw staples outperforming, right, when this ratio was pulling down, was in 2022. Not a good time to be a buy and hold investor. Not a good time to have market exposure. That was rough. We need to be careful, right? We need to be mindful of the level of risk that we're assuming. Also say, make sure you're exposed to the right sectors of the market. We've talked a lot about this rotation from growth to value. And those value names, they're going to include names like these staples. And we talked about this at the PA. One of the reasons that I think that this ratio could have legs to the downside is because the technical setup in a number of these consumer staple names is pretty compelling. It's kind of hard to ignore. They're on former support. Now, they've been terrible, but the setups are pretty good. And so if we're in an environment where we start to see this ratio continue to resolve lower, watch out. Watch out. Okay. Here's the last thing I want to get into. And it actually does involve Exxon. And this is a way that we apply this technical analysis in our business every day here at Reveille, helping clients solve the financial issues that are in front of them. So we have a client retired from ExxonMobil, so concentrated position there, has stock that he gets every year, still coming to him for a number of years. And for a long time, he's been interested in divesting from the position, right? You don't want to have way too much of your net worth concentrated in any one security. But so he gets his most recent distribution of what were formerly restricted shares, RSUs, and he brings them to us, and he's effectively saying, what do you think I should do with them? And our objective for him and for all of our clients is to help them maximize. We want to help you maximize, but we also got to help you manage risk. And so in this situation, we would say, look, from a structural standpoint here, as long as Exxon is above, let's just say $100, right? You could probably look to maintain that position. You could probably hold it because bigger picture, when we zoom out, this definitely does not look like a downtrend for Exxon, right? Pretty good dividend that he's getting. And so we say, okay, look, from a polarity perspective, here's your former high, 104 in the Exxon going all the way back to 2014. If we're above 104 in the Exxon, then we don't want him to sell. But that's his stop. If it gets below 104, we want to take you out. We're trying to help you manage risk. But we happen to think, and we talked about this was kind of the main theme at the PA. Energy looks good. The energy sector broadly looks good and looks like it could be breaking out. Exxon's kind of a leader there. And so here's what we say to him. We want to try to help you maximize. Now, I know that he's perfectly okay when we would sell the stock. He's got enough of it. So what we would tell him is, we're going to help you. We're going to write some covered calls is what we're going to do. But we're not just going to do it blindly. And we're not going to do it just because you're here and you have stock where we could write calls at any point in time. I think our industry does a disservice to a number of investors when they're hired to write calls. They write calls, irrespective of the trajectory of the stock. We're trying to provide some income enhancement, but they never stop to step back to examine, where is the stock in its own cycle? Is this environment conducive to writing calls, to writing options? Or am I simply going to end up underwater on these calls, and I'm going to cost my client performance? I'm going to get them out way too early. So, number one, we can go back and say, from a polarity perspective, we know what our downside risk is. That's going to help us determine our stop. Well, now we're starting to break out. This is where we're going to be able to use some Fibonacci extensions, say from this high to this low, right? On a short-term basis, I think the stock can go to about 143-ish. So as we start to get there, what we want to do, we want to try to help him add what we call a fifth dividend. So as we would creep up towards that 161 extension, we know that we want to look for strikes, option strikes that we can write at that level where we could help him harvest about $1 per contract, right? And so that's what we're currently looking for. I think that naturally, Exxon could get to this level. That's probably where it encounters some initial resistance. But again, that's still fairly short-term oriented. And you know what? If he gets called out at 143, 144, somewhere in there, he's going to be happy, but he's going to be exponentially happier than if we would have just sold the stock when it got here initially at, $100, $105. We're trying to help him maximize. We want to help him manage risk. Technical analysis can help us provide that framework. It helps us to identify what the floor is, where we want to place stops. It can also help us to identify what our upside objectives are, and then where we might want to consider doing some things like writing options or just selling the stock outright. So, all right, that's all that I've got for us today in terms of looking at technical analysis, how a financial advisor can incorporate technical analysis into their process, right? You can certainly use it on a intermarket basis when it comes to helping you make decisions about where you want to allocate capital and when. The other side is the very tactical aspects of when you have clients with concentrated positions and you're trying to help them maximize, optimize, but you're also helping them manage risk. Just the very basics of technical analysis can help you do that by establishing a reasonable stop or a floor where you would take action, and help you identify some upside objectives of where you might want to start to pull some chips off the table. So, all right, guys, as always, uh, feel free to shoot us an email, info@reveillewealth.com. If you have questions about things, we're trying to get this mailbag segment going. Send in your case studies, things that you're encountering out there that you want some advice and guidance on. We're going to do a future show where we pull those out and read them and give you some of our opinions on that kind of stuff. But again, thank you so much for joining us here today on the $1 Million Question. I'm Stephen Weitzel. We'll look forward to seeing you next time. Take care.